China is buying Europe. That's a phrase you've probably heard in the news or social media, from ports and airports to automotive companies and even football clubs. Chinese investors have been pouring billions of euros into European markets. But where exactly is this money going? Why is China investing so heavily in Europe? And most importantly, what will the long-term impact be on European economics and global politics? In this video, we will explore the rise of Chinese investments across Europe, identify the key sectors and countries involved, and discuss what the future might hold for this complex relationship. The rise of Chinese investment is very important. 30 years ago, Chinese companies barely had a presence in Europe. Chinese economy was focused on growth at home, with the most of its international investment targeting Asia and Africa. But things started to change in the early 2000s. As China became the second largest economy in the world, its companies began expanding abroad to gain access to technology, markets and natural resources. Between 2010 and 2016, Chinese investments in Europe skyrocketed, peaking at 47 billion in 2016. This surge was driven by both state-owned enterprises and private companies, often supported by loans from Chinese banks. While some of these investments were small, others were massive and highly strategic, reshaping entire industries. Where China is investing the most? China most isn't spread evenly across Europe. Instead, it targets specific sectors and countries that are vital to its long-term plans. First of all, infrastructure and transport, one of the most visible areas in Chinese investment infrastructure. China's Belt and Road Initiative, launched in 2013, aims to create a network of ports, railways and logistic hubs linking China to Europe. Key projects include Port of Piraeus in Greece, now majority owned by China COSCO Shipping. It has become one of the most busiest ports in Europe. Rail routes through Eastern Europe, connecting Chinese factories directly with the European markets. Investments in airports and logistics centers in countries like Germany, Belgium and Spain. This strategy gives China control over critical gateways for international trade, automotive and high-tech industries. China is also heavily investing in Europe's automotive and technology sectors. Geely, a Chinese automaker, owns Volvo Cars and has a major stake in Daimler, the partner company of Mercedes-Benz. Chinese battery giants like CATL are building factories in Germany to supply the growing electric vehicles market. Tech firms have acquired or partnered with European companies specializing in AI, robotics and semiconductors. These investments aren't just about profit. They give China access to cutting-edge technology. They also invest in energy and utilities. Europe's energy sector has also been a key target. Chinese companies have acquired stake in nuclear power projects in the UK, wind and solar farms in Spain and Italy, electricity grids and natural gas infrastructure in countries like Portugal and Greece. This gives China a long-term presence in Europe's energy transition, while diversifying its own global energy portfolio. They also don't forget about luxury and consumer brands. China's growing middle class has a huge appetite for European luxury goods. To secure a steady supply and global branding power, Chinese investors have partnered with iconic fashion houses, wine producers in France and Italy, even football clubs like AC Milan and Inter Milan. While these investments are more symbolic, they reflect China's desire to strengthen its soft power in Europe. Which countries get the most of investments? Not all European countries attract the same level of Chinese investment. Here are the top destinations over the past decades. United Kingdom. The UK has historically been a top destination due to its open economy and global financial hub status. China has invested heavily in energy projects like nuclear plants, real estate, financial services in London. Germany, as Europe's largest economy and manufacturing powerhouse, Germany is prime target. Chinese investors focus on automotive, robotics, and advanced manufacturing. The Daimler deal is one of the most high-profile examples. France and Italy. These countries are popular for luxury brands, wine and tourism infrastructure. China also buys energy company and transport hubs here. Eastern Europe, countries like Hungary, Serbia and Poland play a key role in the Belt and Road strategy. China builds railways, highways and factories in this region, often through state-backed loans. Greece. The takeover of the Port of Piraeus turned Greece into a crucial node in Chinese European logistic network. Why China is investing so much in Europe? There are several key reasons behind this wave of investment. Access to advanced technology. Europe is home to world-leading industries like automotive, aerospace and renewable energy. Expanding global influence, infrastructure projects and high-profile acquisitions increase China's geopolitical leverage. Diversifying its economy. Chinese domestic growth is slowing, so overseas markets are essential for future profits. Securing trade routes, controlling ports and logistic hubs ensures stable access to European countries, soft power and branding. Owning luxury brands and sports clubs helps shape China's global image. But there are challenges and risks. Why Chinese investment has brought money and jobs to Europe, it's also raised serious concerns. National security. Some governments worry about foreign control over critical assets like power grids, telecom networks or defense suppliers. Example is in 2019, several European countries restricted Huawei involved in their 5G networks due to security concerns. Political influence. Owning key infrastructure can give China political leverage. Countries dependent on Chinese loans or trade may feel pressured to align with Beijing or global issues. Debt traps. Some Belt and Road projects are financed through large loans that small economies may struggle to repay. Critics warn this could lead to a form of economic dependency. Economic competition. European companies sometimes face unfair competition from state-subsidized Chinese firms, which can undercut prices and dominate markets. Europe's response for that in recent years is the European Union has started to pushing back. New rules now allowing governments to screen foreign investments for security risk. Some countries have blocked high-profile acquisitions, especially in sectors like defense, energy, and advanced technology. At the same time, Europe is trying to balance economic cooperation with China while protecting its own industries and sovereignty. The future impact. Looking ahead, China's role in Europe will continue to grow, but likely in a more controlled and strategic way. Possible outcomes are that more joint ventures instead of outright takeovers, stricter regulation to protect key industries, greater focus on green energy and electric vehicles, as both Europe and China transition away from fossil fuels. Geopolitical tension, especially if Europe is caught between US and Chinese interest rate. China's investment in Europe is a double-edged sword. On one hand, it brings capital, jobs and innovation. On the other, it raises questions about control, security and political influence. As this relationship evolves, one thing is certain: the future of Europe's economy will be deeply connected to decisions made in Beijing, Brussels and beyond. Please subscribe this channel, give me comment what you think about cooperation between EU and China.